Robschild. No investment advice. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Tuesday, October 15th, 2024. Today's episode, cracks. The first crack worth taking a look at and thinking about from Market Watch, we had the Empire State Manufacturing Survey come out for October. Last reading of this was 11.5. Expected, according to Market Watch, was 3, and we had a negative 11.9. The Empire State being New York. How is manufacturing doing in New York? If I remember correctly, the last reading of this was expected to be much weaker than it came out, and so for it to be this much lower than the expected at a negative reading, I think partly surprised markets. It was a part of the sell-off today. Part of it was Goldman Sachs earnings not being a blowout, as well as I believe one of the semiconductors reported earnings today, which cracked apart some markets too. When we have oil finally falling off, people are not worried as much as to what's going on in the Middle East, and that's really the long and the short of it. If we head over to the Federal Reserve Bank of New York website, newyorkfed.org, to the Empire State Manufacturing Survey, there's a nice little chart here. If we zoom in, we can see the reading is in here now at negative 11.9. If we scroll out here, as you can see, when we get to this zero line and below, there's a much higher risk for recession, obviously. And so, funny enough, this thing has been largely low ever since, largely below zero ever since COVID, really. And yet we haven't seen a major recession. Some people even say that maybe the recession is already passed. I don't know if you've heard that perspective out there, but it's out there. When we had that dip in 2022 in the stock market. But with the Fed remaining restrictive, it's hard to count that in my book. What's interesting is that we've been sort of negative, and very recently we climbed to positive. Sorry, you can't really see where the zero line is. It's not very clear. But more recently, it looked like we may, be out of the water here, going more positive and then going straight back into negative territory. Now, let's take a look at the limits of this chart going back to 2001. It looks like, in the great financial crisis, this was deeply negative. It got to a low of negative 34. So we're not there yet. But if this continues to break down in the next few reports of this, it could be concerning. Before I go through the rest of today's interesting charts, daily reminders, if you want to hear me read through them all, watch Monday's show, yesterday's show. Every Monday, I reread and go through the things that we need to not forget. They're easy to forget. When the stock market's making all-time highs, it's easy to forget about the bad stuff going on. But these daily reminders are things that we really need to keep in the back of our minds when we're making our investment choices, I'll say. Nothing has been updated today, although, we're getting closer and closer to the 3-month, 10-year uninverting. Not very close yet, but it's going in that direction. But there's not really any other updates, no real updates for the daily reminders. The crystal ball reading remains a bear market very soon, and I am of the belief the Fed won't cut fast enough to save the economy. One thing holding them back from cutting at a faster rate is the fact that we're not at 2% inflation yet. Now, that could come very, very quickly. Typically, in this part of the cycle, it will come very quickly. All of a sudden, one of these readings will be negative or even deeply negative. But for now, we're still strangling the economy. The Fed policies are still restrictive. SPX, the S&P 500, had a pretty good crack down today. This is an engulfing candle of yesterday's gap up and solid green candle. I have been saying I don't know when this is going to stop or even pause, And today was it. In fact, a candle like this signals that we may even actually have a reversal here. 6,000 may even be out of the picture just from this candle on a daily basis. I have said it before, and I will say it again. This could easily be a top in markets. What will change my mind? What will change Robschild's mind to finally give in and say, oh, you know what, the S&P 500 is fine, stocks are fine, the valuations are fine. Earnings. So if we have, like, an earnings season just started, and so if we have company after company just with blowout earnings, just everybody's making loads and loads of money, well, yeah, that can support the S&P 500 valuation. But we need to see explosive earnings, and if we don't, then the current valuation doesn't make any sense at all. I would have expected a larger move up in the VIX today based on the size of the red candle that we had today. It only went up a little bit, but importantly, we're still above 20, which is like still fear mode. The VIX is in fear mode still. And it's been in fear mode as the stock market has been climbing to new highs, which is a divergence. I've been saying on the show, one of them's wrong. Either the VIX is wrong, being so scared, or the S&P 500 is wrong because its price is wildly out of control. And so far, it looks like the VIX is winning this battle with a little crack today in the S&P 500. I think it's likely for that to continue. Yesterday's show, I noted how oil had dropped something like 5%, a large move down, suggesting that would be good for long-duration Treasury bonds, and indeed it would. It was. Treasury bonds got a huge bid today. TLT itself went up 1.2%. Something I haven't brought up on previous shows, I talked about a while ago, was this head and shoulders with the target. You take this line, drag it from the head to the neckline where it broke. It's just amazing how we got to exactly that point at the bottom of this line. This head and shoulders played out perfectly, and we got to the target. And then when we got to the target, we bounced aggressively the other way. Amazing how these chart patterns work. Maybe I should get into more serious trading instead of just trying to invest, but I'm avoiding the temptation for the moment. I like to think of what I do as being less risky and potentially just as rewarding. I mean, you're not typically going to find many traders that are able to get the golden 30% return every year for 10 years. And that's the real goal. That's Michael Burry, that's Warren Buffett, neither of which are traders. But I digress. Moving on to investing.com, notably the chance of zero cut in November has now dropped from 14% all the way down to 7%. We have a 93% probability of one cut. It seems that the few little cracks showing up in the market with oil cooling off, with treasury yields dropping a little bit, it seems like the market is saying, yeah, okay, the Fed is more allowed to have its 25 basis point cut. It's still a few weeks away, and these numbers can change daily. And I'm kind of wondering, now that we're going in that direction, if we're going to see another double cut start to come onto the table, now that we're leaving the idea of zero cut. I drew these lines on the 30-year Treasury yield a day or two ago. These lines represent, well, at least one of them. Okay. This upper one, let's get rid of this other one. I don't know what that's doing there. Oops. Where did it come from? The bottom. So that's a decent trend line. But the main one here is, you can see this giant head and shoulders top. I've been talking about if we cracked through it and confirmed, how that would be surprising to me, since this is such a gigantic, it's an enormous trend line. We never did confirm, unless you count the day that the bond market was actually closed. Somehow Yahoo Finance has a little bar here closing. Oh no, Yeah, right at the peak of that first wick. So yeah, no, we actually didn't get an official confirmation, it looks. And we broke right down below this line, suggesting that where yields look like they are headed lower from here. We poked our head over the line and went straight back down. This is bearish for yields. Obviously, a big part of this is the fact that oil is dropping in price, and yields typically follow oil, the price of oil. It seems like there's some deals going on in the Middle East. People are sniffing out that this is being resolved, at least for the moment, until next time. For anyone holding KWeb, this has been sort of an emotional roller coaster, hasn't it been? I've been holding KWeb for a year or two now because of its severe undervaluation, and suddenly, it had gone from 10% of my portfolio to about 15 with a 40 plus move to the upside, and then more recently we dropped. I guess this is a total of about 25% from the peak. I had been saying that this looks like we're consolidating here as another, place to bounce higher. Again, I view the value of this fund more fair at a $45 to $50 range. Still cheap at a $45 to $50 range, mind you, but not like insanely cheap. And now we're back into insanely cheap mode. Part of this, it has to do with the news in China, with what's going on in the real estate market. Economy is going really slow over there. Another thing to always keep in the back of your mind is that the U.S. economy often follows what happens in China, and we haven't even gotten to the point of having inflation, under control yet, supposedly. While China went the other direction. They've been in disinflation, deflation for a while now. They're trying to turn on the printer and get things going, all while we're still strangling our economy. So if the U.S. economy were to follow China the way it typically does, watch out. This my whole deflation thesis may play out even more strongly than I expect it to. But remember, folks, I'm just the guy with a crystal ball, as always. Another leading indicator I like to take a look at every day is wood continuing to show weakness here, going back down. If we scroll out a little bit, this is starting to look like a blow off top. This is not like a bull flag. This is we went up and elevator up, elevator down. So still looking bearish here in wood. The semiconductor stock I mentioned earlier with the bad earnings today is called ASML, dropping 16% in value. Again, just like the railroad companies back in 1929 and the dot-com companies in 2000, it's inevitable. These companies, all they have to do is not show enormous, growth of earnings with every report, and, they get flushed. So, like they eventually found out that railroads weren't going to make infinite amounts of money forever. It's the same thing with the semiconductor industry. And so the index SMH the entire index had a very large move to the downside as well, dropping 5.4% today. This really could represent sort of the dot-com bubble, but the AI bubble, the semi-chip bubble. This head and shoulders top is still in play, and if we do get down to this neckline and break it, it could really drag the entire market with it, considering how much weight semiconductors have, especially NVIDIA, in the overall markets. And we see evidence of that more clearly in the triple Qs and the NASDAQ. Even the S&P 500 was bearish today, but that also involved banks. But the NASDAQ, we still are also in this longer term head and shoulders top. We have not broken to new highs in the NASDAQ. So we'll see if this Head and Shoulders. I've been talking about this since this summer as playing out as a Head and Shoulders top, so there's still a chance for this to play out the way that I see in my crystal ball and all. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.